All right, let's talk about January 5th, 2026. This was a day when the markets did something that honestly seemed completely impossible. Today, we're going to break down the anatomy of this incredible record breaking rally and figure out how a massive geopolitical crisis actually ended up fueling one of the biggest single day gains we've ever seen.
So the fuse was lit over the weekend, and the news that came out was just shocking. U.S. special forces had gone into Venezuela and actually arrested President Nicolas Maduro. Now, this wasn't just some small regional issue. No, this was a huge signal of a bold, very aggressive new U.S. foreign policy right in its own backyard.
Okay, so you hear about a major military intervention, a geopolitical shockwave like that. What do you expect? You'd think the markets would just plummet, right? Fear, uncertainty, all that stuff. But that is not what happened, not even close. Instead, the Dow absolutely soared. It closed at a staggering 48,977 and even broke through 49,000 for the first time in history. Just incredible. And that, right there, brings us to the big question we're tackling today. How on earth is that possible? I mean, how can a military intervention, something that's usually packed with risk, end up triggering a historic, record-shattering rally? Well, that's exactly what we're going to unpack. You see, the answer really starts with how the market chose to look at this whole thing. It didn't see chaos or risk. It saw a strategic checkmate, a long-term victory for American energy and, economic dominance. So, here's the crucial point. The whole narrative just flipped completely. Instead of being scared of instability and oil prices spiking, investors immediately started pricing in all the good stuff, securing all those Venezuelan oil reserves under U.S. influence, kicking China and Russia out of the neighborhood, and putting long-term downward pressure on inflation. The market didn't see risk. It saw a massive opportunity. And the proof is right here in the sector performance. I mean, this slide just tells the story perfectly. Take a look at the numbers. The energy sector was the day's biggest winner, surging 2.67%. And at the same time, the classic safe bet, the utility sector, was the worst performer, dropping over 1%. This is a classic risk-on signal. It shows investors were dumping safety and piling into things that would benefit from this new strategic world. And this just brilliantly shows you which companies were set to win big. You have Chevron, the only major U.S. oil company with a real footprint still in Venezuela. Their stock jumped 5.7%, just on the hope that those assets could come back online. But the real star of the show, Valero Energy. It skyrocketed 9.2% because, get this, its refineries on the Gulf Coast are perfectly designed to process the exact kind of heavy crude that Venezuela is famous for. But here's the thing, as powerful as that geopolitical story was, it was really just the match that lit a powder keg that was already waiting to explode. The real engine driving this market wasn't in Venezuela at all. It was in Silicon Valley, and it was powered by the artificial intelligence productivity boom. So let's quickly break down the three pillars that are really holding up this whole AI rally. First, you've got a memory chip supercycle in full swing. We're talking giants like Samsung and SK Hynix talking about raising server DRAM prices by up to 70%. Second, the big banks are seeing huge efficiency gains from AI, letting them cut costs, while investment banking is just roaring back. And third, the U.S. government just announced a $2.7 billion investment to secure the nuclear fuel supply chain. Why? Because of the massive new power demands from all these AI data centers. Now, what's really fascinating is this quote from the respected banking analyst Mike Mayo. He's basically arguing this isn't just some temporary surge for banks like JP Morgan and Goldman Sachs, which, by the way, all hit record highs today. He thinks we are only 1/3 of the way through a fundamental re-rating of the entire banking sector, all thanks to AI. So we've got this powerful geopolitical story and this unstoppable AI engine. But at the exact same time, the real economy was flashing some pretty serious warning signs. And this put investors at a crossroads. It forced them to choose which story they were going to believe. And here is that big conflicting signal, the December ISM Manufacturing PMI. That's a key survey that tells us if the factory side of the economy is growing or shrinking. It came in at 47.9. Now, anything below 50 means contraction, and this was the 10th straight month of it. The physical economy is definitely struggling. So how do investors deal with that kind of negative data? To understand that, we can look at a key sentiment indicator, the CNN Fear and Greed Index. It basically blends 7 different metrics to give us a snapshot of what's really driving people's behavior. And the reading today? Yeah, firmly in the greed zone. This is so crucial. Investors are looking at that weakness in manufacturing,
not as a reason to sell, but as a reason for the Federal Reserve to cut interest rates, which would just pour more fuel on the rally. It's a classic case of bad news being treated as good news. And we see even more evidence of this lack of fear right here. This is the VIX, the market's fear gauge, and it measures expected volatility. And while it did tick up a little bit today to 14.9, it's still way below that 20 level that signals real anxiety. The market is feeling calm and very confident.
Okay, so when you put this whole complex picture together, a geopolitical win, an AI boom, a weak real economy, and just rampant optimism, it presents a really clear strategic choice for investors. Do you press the attack, or do you start to play defense?
So this slide basically lays out two different playbooks. The aggressive strategy says you lean into the AI momentum. You could use ETFs like SMH for semiconductor stocks, or maybe BAI for a basket of AI leaders. The big risk, of course, this could all be a bubble. The stable strategy is more defensive. It focuses on value, kind of like the dogs of the Dow theory, of buying high-dividend blue chips. For that, you could use an ETF like SDOUG or XLF to get in on that financial sector rally. The risk there is that if inflation stays high, the Fed won't cut rates, and that could hurt these more traditional names.
When it's all said and done, the best metaphor for today's market is probably a nuclear-powered aircraft carrier. You know, it ran into a geopolitical hurricane, but it didn't even flinch. It just powered right on through, propelled by these unstoppable twin engines of American energy dominance and the AI productivity revolution. And that leaves us with the final and most critical question. The market has placed this massive bet on a future defined by American power and artificial intelligence. So the question you really have to ask yourself is this: are we witnessing the dawn of a new technology-led economic boom, or is this just a historic rally that's dangerously ignoring all the warning signs flashing from the real economy?